We are still in the corporate liquidity analysis. We have just finished the static method of measuring the liquidity of the company. We have already expressed its limitations. Here, a current ratio, which is the static method for measuring liquidity, is an accounting approach. Now we come to the dynamic measurement of corporate liquidity. In this method, we consider the cash-to-cash cycle, meaning the period of time between when company makes cash payments for the inputs into its production process, like the raw materials, and when the company collects cash from the sale of finished products. This is the most important determinant of liquidity of a company. Based on the definition of liquidity, it takes cash to make payments. To repay debt, a company requires cash. So we have to look at the cash-to-cash cycle of the company. When a company makes cash payments for the raw materials, and when it collects cash from the customers for the sale of the products, finished products, produced from these raw materials. Now that length, cash-to-cash cycle, sometimes called operating cycle, is determined by the decisions of the operating managers, marketing managers, production managers, purchasing managers. And that cycle also determines the working capital amount that the company holds. Now, in the dynamic measurement of corporate liquidity, we have to establish the length of the cash operating cycle, cash-to-cash cycle, the working capital amount, and the sources of funding. The levels of working capital assets, like inventory amount and trade account receivables, are directly proportional to the length of the operating cycle. The longer than the cycle, the larger the amount of working capital assets a company would hold, and that amount will determine the net working capital investment amount. Corporate companies finance working capital investments with short-term funds and long-term capital. We can divide the working capital into two parts: temporary working capital, which is related to temporary growth of the company, and permanent working capital amount. Now, based on the funds matching principle, to balance risk and return, it's always appropriate to fund the permanent portion of the working capital with long-term funds and use short-term funding for the temporary working capital or the temporary buildup in inventory, account receivables, and account payables. Now we come to the computation of liquidity position of a company. We shall use the financial statements of PCP as a case study. Now, liquidity position of a company depends on three variables: the amount of long-term funds, the strategic investments of the company, and working capital investments. So LP, or liquidity position, equals to long-term funds, which means long-term debt, plus total equity, minus strategic investments. These are long-term investments in the core business of the company, and then we divide that amount by working capital investment. Finance theory holds that the level of liquidity position of the company is in direct proportion to the amount of working capital investment and the source of funding used to pay for these working capital investments, inventory level. To calculate the liquidity position of the company, we take the long-term funds from the balance sheet of the company. Long-term funds is the sum of long-term debt and total equity. For 2023, PCP had 211.9 billion baht of long-term funds. We also must have the strategic investments amount. How much money the company has invested in its long-term productive assets. That's 165 billion. You will see that number, how to calculate these numbers on the Excel, the computation section of the Excel file. And then the working capital amount. Working capital is the inventory amount, trade accounts payable, minus the trade accounts payable. These three variables, inventory, trade account receivable, trade account payable, are directly related to the operations. So we divide, we get liquidity position of 117%, meaning working capital is 100% financed with long-term fund. So the liquidity position is good in the sense they have time to sell the inventory, raise cash, and repay the debt. 100% of the working capital is funded with long-term funds. That indicates the company's position is good, liquidity position.